Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thanks for tuning in to our Real Estate Radio Power Investing program, where we empower you with education to maximize your investing success. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. And you can go to TomWilsonProperties.com to get a lot of investor information about investing in syndications and commercial real estate, and a lot of other information, including about the economics of this market. And speaking of that, we have with us today one of my favorite economists and speakers and authors on the economy of the country and of the world, Peter Schiff. Peter Schiff has a degree in finance and accounting from UC Berkeley. He's had 25 years of financial professional experience, and he's president of Euro-Pacific and chairman of Schiff Gold. And Peter was one of the very few that called the crash just right before it happened. And when you find someone like that, you want to follow them. He frequently appears on TV, newspapers, and radio. Has a best-selling book, Crash Proof, and how to profit from the coming economic collapse, which happened, but not as far as he says it should have happened. He's got another book out now called The Real Crash. So take your antidepressants and tune in here and learn about what happened, what didn't happen, and what might be next, and what you can do to help take advantage of the situation when the next recession happens. Peter, welcome back to the program.
Oh, hi. Nice to see you again, Tom, here in San Francisco at the Muddy Show.
Indeed. So we're here at one of the nation's top shows for investing in San Francisco, 3-day program, and Peter's here as a featured speaker and here at the show. What would you say, Peter, is the kind of the general message and attitude that you're hearing from folks walking through and attending this? Folks bullish? They're getting nervous? What do you think?
Well, there's probably still a lot of optimism and bullishness. I mean, the Dow Jones is just off an all-time record high, 22,000, and of course, Donald Trump is president, and there are a lot of Republicans that invest in the stock market, and they feel more optimistic about the future now than they did during the 8 years of Obama. So I think the enthusiasm level is pretty high. I mean, people think the market's going to keep on going up, and they feel that there's going to be some progress made on the regulatory front, on the tax front, that is going to be a positive for the economy. And unfortunately, I think all of this optimism is unfounded, and I think it's going to prove to be very, very dangerous for a lot of people. Just like, you could be confident that, let's say, the ice is solid and you go venture out on it because you have a lot of confidence in the integrity of the ice, and then you drown because you were wrong. And I think there are a lot of people that are, making mistakes based on confidence that they shouldn't have.
And sometimes confidence is not based on fact, right?
No, it's based on hope. And I understand that people want to be hopeful and want to be optimistic, but you've got to look at reality, and that's how you have to invest. You can't invest based on the way you hope things are going to be or based on the way you'd like them to be. It's got to be the way things really are. And if you have a realistic look at the U.S. economy and the U.S. markets, you're going to come to the conclusion that I did, that there is a tremendous amount of risk, not only in the market, but in the dollar, and that if you're an investor, you have to be cognizant of those risks, and you need to invest accordingly.
So, Peter, when you've said that everybody is kind of glad that the crash that happened was over. And now we're past that, and of course, people's memories are amazingly short, and they don't realize or remember that these business cycles are naturally occurring, and that one went on much longer than it should have. It amazes me there weren't more people that called the crash correctly like you did. But what did happen that you had predicted, and what did not happen that you had predicted during the last crash?
Well, I mean, pretty much everything that happened is something that I predicted. I didn't predict the large reflex rally that the dollar had when the crisis began. And so that part I didn't necessarily take into effect, but pretty much everything else happened the way I thought. The one thing, though, that I didn't necessarily get right, although I didn't get it wrong either because I didn't put a time on it, but I believe that the events of 2008 that I forecast, the Great Recession and the huge increase in unemployment, the financial crisis, all those problems would result in the government slashing rates, printing a bunch of money, trying to reflate the housing bubble, reflate the stock market bubble. I thought they would do all that, and they did do all that. But then I thought that the result of that would be a collapse of the dollar, and that hasn't happened yet. The dollar hasn't collapsed, even though we've had all those programs that I predicted we would have. And I don't think I'm wrong. I think it's coming. I'm just surprised that the gap between the events and the ultimate crisis that those events are going to produce. But I think we're getting close, because if you look at the dollar today, we're off to the worst start since 1985. The dollar hit a new low for the year today. It's at a 2-year low against most currencies, and the air is only starting to come out of this bubble. The last time the dollar was this weak to start a year was 1985, and that began a 10-year decline in the dollar. And I think this is going to be a much bigger dollar decline. I think the fundamentals are much worse now than they were back in the 80s, or even the last time we had a big dollar decline, which was in the 2000s. I think this is going to be much worse, and I do believe it's going to end in a crisis, a currency crisis, a sovereign debt crisis. And I think it's going to be many, many times worse than the financial crisis of 2008. And, as many people, if not more, are going to be blindsided by it. They're not going to see it coming. And a lot of portfolios are going to be decimated, along with the standard of living of most Americans. Even
our friend, Dr. Doug Duncan, chief economist at Fannie Mae, has told us not only to remind people that all expansion's in, but this is one of the weakest recession recoveries that we've ever had.
It's one of the weakest, but it's also one of the longest. So you got to figure it's going to come to an end. And it's also required a record amount of artificial stimulants. So despite, the most effort ever to create a recovery, what they've created is the weakest one yet. And of course, whenever you create a phony recovery based on printing money and debt, all you do is sow the seeds for the next downturn. And the bigger, the more you inflate, the bigger the stimulus, the bigger the downturn. It's always proportionate,
as we just experienced.
Yes. So, and since this phony recovery required a lot more government stimulus than the one that Greenspan used to create the housing bubble,
right,
you can only imagine what we have in store for us now, because this is going to be, again, an order of magnitude greater than 2008.
Is our false recovery and our record levels of market strength, or not strength, but levels of both in housing and in the market, is this all created by the stimulus money and the unrealistic subsidized interest rates and policy that
a lot of it is a byproduct of that. I mean, there are other things that act to distort the markets. Governments have regulations and taxes and subsidies that also impact on that. But whenever you have government manipulating the markets, through legislation or monetary policy to create an outcome that the free market would not produce, you are causing a problem. And ultimately, the free market will be allowed to correct that problem before it gets even bigger, and there you get a recession. But the recessions are actually the cleansing process of the business cycle, where the market is trying to restore order and balance and fix the mistakes that government policy created. But again, the bigger the mistakes, the bigger the busts, right? It's, if you're really, really sick, you need a lot of medicine.
And when you have this many pills given to a patient, it's hard to predict the prognosis, right, of the patient, or at least the timing.
Yeah, well, that is pretty much impossible to do. But, as far as I'm concerned, there's two ways to time it. You could be too early or you could be too late. So
Gee,
Too early
which
is
one,
the only
which
one
one would
that
you
makes
rather be? No. I don't know if you know the quote from the great-grandson of the Lafitte Rothschild family. He was asked, the Rothschild family was at one time wealthiest family in the world, and he was the great-grandson was asked in the 70s in an interview to what single thing did he attribute his family's great wealth, and he said by getting out too soon.
Oh yeah, because you can never pick the top, and those that try never end up getting out.
Well, you never know it's the top until it's past the top, right?
Yeah, and even then, you don't know it's the top because you're still thinking it might go back up. So usually it has to completely collapse before you realize that was the top.
Now, a lot of folks here probably at the Money Show would say, but my gosh, Peter, if I'd taken that advice 3 or 4 years ago, look at all the money I would have lost in the gain.
That's true.
But of course, they haven't really sold, right? It's still sitting there on paper.
Yeah, they can talk to me when they cash out, but also what they do with that cash. Because if you cash out with a pile of dollars and then the dollar crashes, you still have nothing. But, anybody who began following my advice at the beginning of this year, even if they sold all their stocks earlier at the beginning of this year and they bought foreign stocks, they're doing better. And if they started following my advice at the beginning of last year, they're doing better. So, at this point, it's the people that are in the U.S. market that are underperforming the people who are invested outside the U.S. market. So what we're doing with clients, I'm not just telling people, hey, sell all your investments. I'm giving them an alternative strategy. And that strategy, after several years of underperforming because we had a dollar bubble, now that the air is starting to come out of that bubble, my strategy is performing, and it's going to get better and better and better as the dollar comes down. And now as more people realize that the Fed didn't cure the disease, they made it worse. We're sicker now as a result of their phony medicine. And now you're going to start to see capital flows. People are going to be leaving U.S. assets in search of better safe havens, true safe havens, and I'm already there. So money is going to start flowing into the assets that I already own, and it's going to be bidding up the prices.
What do you think for those that are nervous about cutting that umbilical cord to what they have as perceived value about them dollar cost averaging out and slowly pulling out and then putting funds into other things?
Pulling out slowly is better than not pulling out at all.
Yeah.
But you run the risk that you don't pull it all out and it crashes and you've only protected part of your wealth. I think the U.S. stock market is so expensive that even if you're not expecting a crisis, there's no reason to take the risk. I mean, you have so much better value historically in the markets that we're investing in. I mean, even if there isn't a problem, you're probably going to make more money invested abroad because you're getting a much better deal. You're taking less risk because you're buying earnings at a lower multiple and you're getting a higher dividend. So, all things point to an overvalued U.S. market. Whether I'm right or not about the collapse, there's no reason to invest in America when you've got a better risk-reward dynamic in other countries. But if I am right, you better follow my advice, because if I'm right and you don't, you're in some serious trouble.
We got Peter Schiff here with us today on Real Estate Radio Power Investing on KDOW 1220 AM, the Wall Street Business Network. We're going to take a short break and then ask Peter some more about his alternatives and things that you consider other than what you're invested in now. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We're here with Peter Schiff at the Money Show in San Francisco, where we have thousands of investors that are looking for places to put their money. And Peter Schiff is with us, one of the few economists that called the crash right the last time, and he says maybe it's about time it's going to happen again. He's surprised it's gone up as much as it has. Peter, it sounds to me like your thought is, at this stage of the game, forget about trying to figure out when the time is ultimately to get out. It's already there, and maybe you leave some money on the table, but you'll be better off if you pull out now and put in some other things that aren't as vulnerable.
Well, I mean, first of all, I don't even think we're leaving money on the table. We're getting onto a better table. We're going to a table where we got better odds and we got more upside. Because I'm not telling people, hey, sell your U.S. stocks and just put the proceeds under your mattress. I'm saying, hey, I've got better ideas. Sell your U.S. stocks and buy these stocks in Singapore, buy these stocks in New Zealand, buy these stocks in Switzerland, because you've got better upside, less downside, and you've got the added benefit of being out of the U.S. dollar into a currency that's going to gain value as the dollar loses its value. And so that, people just need to make these changes, make these shifts in their portfolio now, without worrying about missing out on some further upside. Because I think even if the U.S. stock market keeps going up, it'll go up more slowly than the markets that we're investing in.
So tell us about Euro Pacific and what kinds of alternatives that your company offers.
Well, I offer access to a lot of international markets that most firms basically don't allow their clients to engage in. They just don't allow the direct purchase of stocks that don't trade on any U.S. exchange, and we do. But also, we have a lot of managed accounts where I will manage your portfolio in foreign stocks. Again, most foreign stocks that typical brokers don't even look at. They're not even on their radar. They don't look at things unless they trade in America. And I look for the best value no matter where it is. I don't care if it's not listed in this country. If it's a better investment, I'm going to go and make it. And so if you really want to get exposure to these smaller markets that have companies that aren't listed in the U.S. and that most analysts here don't follow, we can do that and other firms can't. And I think that's where the returns are going to be. That's where the real value is now. These markets have been overlooked. And as a result, you've got opportunities. And at some point, more and more people are going to be looking in these markets when they're, getting out of the U.S. market, because all of a sudden the problems that I've been forecasting become reality. They become history, not like just a prognostication. And, of course, you want to beat them to that, right? You want to get there first, because by the time the big money is trying to get into these markets, the prices have to be much higher to accommodate those flows.
Yep. And Schiff Gold, you're the chairman of that and founder. So what's your advice to folks considering metals? Now, I know Andy Tanner, Robert Kiyosaki's securities advisor, says, I get that there's some value in having metals, but one thing that bothers me about it is it doesn't produce any income. Would you say most of your investors are buying metals more as an investment or as an insurance policy?
Well, there are a lot of things that don't produce income. Dollars don't produce income if you just put them in a safe. Even if you put them in the bank these days, they don't really produce much in the way of income. So the fact that there's no income on gold is not a reason not to own it. Now, it is a reason not to only own gold. There are people that all they want to buy is gold. No, you've got to have income-producing investments. You've got to have dividend-paying stocks or rental property or, bonds. But you need to have some gold that I think of as liquidity. It is, in a way, an insurance policy. It's an alternative to cash. And, if things really collapse, if there's a problem and prices collapse, then you could use your gold to buy more assets, because gold is very liquid and it's very portable and it's, easy to store. So everybody should have some money in gold, 5-10% of gold, but don't expect it to pay a dividend, because that's not why you're buying it. If you want dividends and you want gold exposure, there are some gold companies. There are mining companies and royalty companies that you can buy that will give you exposure to the upside in gold, but will give you the income that you get from having a business, being a shareholder in a going concern.
Okay. And so if you have gold for insurance policy, would you say that you don't count on that for buying groceries? You got to have other assets or other currencies in order to buy.
You could use your gold to buy groceries. You could get a lot of groceries for an ounce of gold. But, of course, if you want to use your gold for those small purchases, people should go and open up an account at goldmoney.com. And there you can buy gold online over your cell phone with an app. And you can buy physical gold that you actually own. They'll store it for you in a Brinks vault. And now you have a digital wallet, and you can actually use that gold to buy goods and services, or if you're selling goods and services, you can be paid in gold. Now, of course, in order to be paid in gold or pay in gold, the other party needs to also have a gold money account, and then you can transfer some of your gold to them, or they can transfer some to you. It's free. It happens very quickly. But what gold money will also do is give you a free debit card, a MasterCard, so that if you want to spend your gold and the person who's selling you the product doesn't want your gold, then just give them that MasterCard, and they'll get dollars, and then your gold holdings will be reduced to reflect what you just spent. But that gives you the ability to use your gold as an everyday medium of exchange to go about and conduct your daily life, but know that your savings are secure because they're in gold. You go to bed every night knowing that whatever you didn't spend is in your own vault in gold. It's not in some over-leveraged bank in a bunch of paper that could end up being worthless.
We got Peter Schiff here with us today on Real Estate Radio Power Investing on KDOW 1220 AM, the Wall Street Business Network. We're going to take a short break and then ask Peter some more about his alternatives and things that you consider other than what you're invested in now. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We're here with Peter Schiff at the Money Show in San Francisco, where we have thousands of investors that are looking for places to put their money. And let's face it, we're already, to some degree, most people are already spending money that's not physical, right? They don't have tangible currency much anymore. They're debiting things that are held out there in the cloud, right?
Yeah, I mean, most of the things that people buy something nowadays, they just use their debit or credit card anyway. There's not a lot of cash going around. So yeah, I mean, it's no different. Now, of course, there are people now that are thinking, well, Bitcoin and other digital currencies are going to be the future. I think this is just a fad. It's just another financial mania like the tulip bulbs, and it's going to end badly for the people that that stay too long to the party, which will be most of them.
Well, so why is that? Now, I understand there are 5,000 fintech kind of companies out there now,
well, there's a lot of companies that are growing up around these digital currencies, but they're all going to go broke. Just like there are a lot of companies that were created to service a lot of dot-com companies. And when the dot-com companies went broke, so did those other companies. I mean, so a lot of mistakes are being made as a result of this bubble.
Is that partly because the Bitcoin isn't tied to anything tangible?
Yeah, it doesn't have any real value. It's not going to succeed as money. Meanwhile, the success as far as the appreciation has spawned so many copycats. There's 1,000 digital currencies now, and their numbers grow every day. So, I mean, there's an unlimited supply of virtually identical currencies that can be created out of thin air by anybody. And, of course, as technology improves, they'll make better digital currencies. But, of course, I think eventually the technology will exist to crack these codes, and people think, oh, it's safe and nobody can get into it. Well, that's with today's technology. You don't know what tomorrow's technology is going to be, right? I mean, so somebody comes up with a way to crack the blockchain, and so that's it.
It's not a matter of if, it's a matter of when.
Yes, like it's going to, But the alchemists have been trying to make gold out of base metal for hundreds of years, and they haven't succeeded.
Peter, if people want more information about your companies and business, how can they reach the
Well, on the internet, my website is europac.com, EUROPAC.com, schiffgold.com for your precious metals, and, follow me on social media. I'm on Facebook, Twitter, YouTube, and I do my own podcast, The Schiff Report. It's on, you can get it on iTunes or Stitcher, whatever it is, and SchiffRadio.com is my website that hosts the Peter Schiff Show, and also you can check it on my YouTube channel, Peter Schiff. So there's a lot of ways to follow me on the internet. Even if you're not investing with me, you can still learn from me and get some real news instead of the fake news.
Just go Google Peter Schiff, and you'll see his face all over the place out there.
All right,
Peter,
thanks.
Peter, thanks for being with us today. I appreciate it very much.
Bye-bye.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Welcome back to Real Estate Radio Power Investing. So we're here with Jennifer Zhang, who's talking to me about commercial investing, what the advantages are, and so forth. So,
right, Tom. So you mentioned commercial investing, and you mentioned there's so many different kinds of asset types within commercial. Can you tell me a little bit about the pros and cons of each commercial type?
Indeed. So multifam is generally considered the lowest risk because it's it's where people reside. Everybody has to reside somewhere. However, because of that, there's often more demand than there is supply. So right now, especially in this market, what we find is, even though I've owned, I think, 9 multifams, what we have observed in most major markets, multifams are not returning as much now as other types of commercial products. So what are some of these other types? Well, there's retail, and there's different kinds of retail. You can have single-tenant retail, such as the famous example of a Walgreens or a McDonald's. And as you would guess, since those are national names that everybody knows, they're considered very safe. And, of course, when you have something very low risk, you get much less return. You go into a major city like a San Francisco, and 3.5% returns is about all you're going to get for them. But there are other kinds of single-tenant properties and, say, in retail that can give more. They might more returns. That might be a regional example. Then there are strip malls or service centers in neighborhoods. Those we really like because they have a service component. They don't tend to compete with the internet. As far as I can tell, I haven't heard of anybody getting their hair cut or or drink a beer or take their dog to a veterinarian who's on the internet. So I think these service centers will be around for a long time, and they aren't very threatened by the e-commerce. Then there are large power centers. And the large power centers in retail are the ones with the traditional anchor stores. And those anchor stores may be struggling with internet, and they may not be. So just because they're a big anchor store doesn't mean that you need to run like heck. And as we see in our recent example of the largest e-commerce company in the world just buying Whole Foods, and that really shocked everybody. So you can see from that example that, again, you don't want to broad brush the conclusion about any asset class or any metro for that example because you hear some bad headlines about some types of them. Office buildings can be either single or multi-tenant. Most of them tend to be multi-tenant. We like office if it's the right one in the right place. I think in this market you want to have a particularly good buy, and you got to be very careful about where it's located. Sometimes you go across the freeway and the market is quite different. So as always, even though we have a lot of experience in investing, we always look for someone on the team that's got experience and expertise in that particular product or that particular submarket, and both. And then there's industrial. Industrial is often, I think it's the one that's a little bit under the radar if there's anything that is. They're hard to find, good ones too, but easier than the other asset classes that I've discussed these days. Why? I think because they aren't a household name typically. They're often the companies that make supply chain infrastructure product that is critical for manufacturing all kinds of products for the country and the world. People don't know about it, but they're critical. Often we can find single-tenant industrial products that have 10, 15, 20-year leases on them, and they've been around for a long time, so find the right ones of those. We like them a lot. So that's the main kinds of asset classes. They're warehousing and other things, but those are the top four.
Tom, I know you mentioned the word syndicator and syndication a lot in the first segment. Can you define what a syndication is for our listeners? So
syndication sounds like it's some complex thing that maybe maybe even isn't legal.
Why do you say that?
Well, we had a client ask us one time, is that legal? Because, you hear about the mafia and their syndicate. But at least the ones we do are legal, and I think most of the ones offered out there indeed are. It just means that you're putting together money from more than one person to for some common cause with the result of that. I'm sure back in Egypt and thousands of years ago, there were families that got together and bought a goat and shared the milk. So that's a syndication. This day and age, syndications are well regulated. They're part of the SEC regulations, and you can either and a private syndication is one where you've put together funds from many different investors to buy a single product. In the real estate world, it's typically a real estate building. So you can have very large blind funds where a large organization will buy and sell lots of products. It's more like a mutual fund, and you don't have any kind of knowledge ahead of time of what their intentions are to buy, maybe categories, but not specific ones. And in that case, you're in long term, and like all syndications, you're largely investing in the reputation of the syndicator. But for a smaller syndicator like Wilson Investment Properties, we have products that we find, vet, and then put a corporation in place that buys that product, and then the investors can buy shares in that corporation. Then there's a management company like ourselves who will manage that product for its lifetime. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Welcome back to Real Estate Radio Power Investing. So we're here with Jennifer Zhang, who's talking to me about commercial investing, what we do, and why we think it's what we do is particularly good. We, first of all, have many associates that are looking for products, and they specialize in different metros. They specialize in different asset classes. And so the ones that we connect up with are experts in those fields. So we go through many products that we that they're looking for to find the best ones, then do a very thorough due diligence before we offer it. So with our company, you are able to invest in specific products in specific locations that you like. Any syndicator that's really good should have a long track record, as we do, of having success in what they do. Should have full transparency, and that they are providing tremendous amount of information to help you make a good decision, and should stay in communication with their clients so that they're always keeping them up to date with what's going on. Even if it's not good news, the investors deserve to know what's happening with their investment. After all, it's their investment, it's their product, and we're the ones that are going to do our best to make sure that it provides the results that we predicted. So also a good syndicator will make most of their money at the end of the deal. They will always have a specific hold period that is defined up front, and the syndicator will not get most of their profit until they have performed as they projected.
Tom, if these are private placement securities, how does someone find out about investment opportunities with, say, Wilson Investment Properties?
Well, there are different ways that the SEC allows a syndicator to offer shares and products to its investors. The one that's used most is called 506B within the Reg D of the SEC regulations. And in that case, the investors that are allowed to invest have to be ones who already have a relationship or connection with that particular syndicator. So if you're interested in investing with a particular syndicator. You've heard about them. They have a good reputation from what you've heard, and you want to know what their offerings are. You need to go to that syndicator and establish a relationship, and it can be just as simple as going to sign up for, say, a newsletter or registering with them. So in the case of Wilson Investment Properties, you go to tomwilsonproperties.com website, and there's an opportunity there to sign up. You'll get a weekly newsletter that shows that gives you economic news in the real estate world on a weekly basis, and also as new products come out, you get to look at them and have the opportunity to invest them if you choose to. And if you don't want to invest in that kind of product, that's fine. You can wait for the next ones. So I think with the other kinds of most popular syndication is a 506C. 506C allows you to advertise the general public, but it's not used very often. Occasionally we'll offer something like that if it's maybe a very large raise, or it's something that you think you might need to go outside your own database, and occasionally just to let the general public have opportunity to invest in something that normally only large investors and institutional investors have the opportunity to invest in. So thanks for being with us today, Jen.
Thank you, Tom.
This is a very exciting field that we're in. There are very few people who really know about the opportunities of syndication. It's a very passive investment. You have no liability, and we gives you an opportunity to make some returns that are much higher than a lot of other kinds of investments, and we think very predictable returns. So thanks for being with us today, and thanks for listening to Real Estate Radio Power Investing on KDOW 1220 AM, the Wall Street Business Network. And again, you can go to tomwilsonproperties.com to sign up for our newsletter that comes out weekly, along with giving you opportunities to see the investments that we have as soon as they're made available to our own client base, and a lot of investor information on the website, tomwilsonproperties.com. We also do this weekly radio show is available there. You can go look at the podcast and look for the topics and different speakers, different guests that we have on, and look at listen to the material that they have to offer. We are very fortunate to have some very significant experts in the country that we have on those podcasts. So again, thanks for being with us, and remember, the only thing that matters is what you do next.